Ever wondered how some people seem to predict the stock market's movements with uncanny accuracy? Welcome to the world of technical analysis, a method that financial experts use to forecast future stock prices. This strategy is not a wild guess or a gut feeling, but a systematic approach based on the study of past market data, primarily price and volume. Here's an interesting fact. Technical analysis differs significantly from fundamental analysis. While fundamental analysis dives deep into a company's intrinsic value by examining its financial statements, earnings reports, and market environment, technical analysis focuses solely on patterns and trends in price movements and trading volumes. So it's like comparing apples and oranges. Both fruits, yes, but with different flavors, textures, and nutritional profiles. Similarly, both technical and fundamental analyses serve the same purpose: to make informed investment decisions, but they approach this goal from different angles. So you might be wondering, how does technical analysis work? Well, that's where things like candlestick patterns and chart patterns come into play. Have you ever heard of candlestick patterns? No, it's not a new craft trend, but a key tool in technical analysis. Candlestick patterns, ladies and gentlemen, are the language of the stock market. They are graphical depictions that represent price movements within a given time frame. Now, these aren't just random shapes and lines. Each pattern tells a unique story about the battle between the bulls and the bears in the market. Let's take a closer look at these patterns. One classic example is the bullish engulfing pattern. Imagine two candles. The first one is a small red signifying a price decline. The second is a large green enveloping the body of the first one, symbolizing a price increase. This pattern signals that the bulls have taken control and a potential uptrend may be on the horizon. It's like a plot twist in a thrilling novel, shifting the momentum in favor of the bulls. On the other hand, we have the bearish doji. A doji is a candlestick with a virtually non-existent body, signifying that the opening and closing prices are nearly identical. When this doji occurs after an uptrend, it can indicate that the bulls are losing steam and the bears might soon take over, potentially leading to a price decline. It's like a cliffhanger in a suspenseful movie, hinting at a possible change in the storyline. But remember, just as one sentence doesn't make a story, one candlestick pattern doesn't determine the market trend. It's important to consider these patterns in context, looking at them in conjunction with other patterns and indicators. Understanding these patterns can provide you with valuable insights into possible future price movements. It's like learning a new language, where each candlestick pattern is a word, and together they form sentences giving you a narrative of the market. Candlestick patterns are just one aspect of technical analysis. Another crucial tool is chart patterns. If candlestick patterns are the words, then chart patterns are the sentences of the stock market story. Chart patterns are the identifiable shapes formed by price movements on a stock chart over time. These patterns aren't random doodles or abstract art, but rather they're the illustrations of the market's behavior, its ebb and flow, its highs and lows. They're the visual language of the market's history, and if read correctly, they could provide insights into its future. Let's consider a couple of examples. One common chart pattern is the head and shoulders. This pattern resembles a head with two shoulders, hence the name. It's a bearish pattern, indicating that a stock's price is likely to fall after the pattern completes. On the other hand, there's the double top pattern. As the name suggests, it features two peaks, almost like mountain tops. This pattern also suggests a reversal from an uptrend to a downtrend. The ability to recognize these patterns is a vital skill for successful technical analysis. Each pattern tells a story, a narrative of the stock's journey. They're like clues in a mystery novel, guiding you towards the potential plot twists of the market's future. So we've covered candlestick and chart patterns, two of the key tools in technical analysis. But what does all this mean for you? Technical analysis, with its candlestick and chart patterns, can seem complex, but it's a powerful tool in your trading arsenal. It's not just about recognizing shapes on a graph. It's about understanding the underlying psychology of the market, predicting future price movements, and making informed decisions. With it, you can navigate the ebb and flow of the market, potentially leading to more successful trades. Remember, the stock market may seem unpredictable, but with technical analysis, you have a way to decipher its patterns and trends. Happy trading!